is John Pinto, your roving realtor, bon vivant, video blogger, raconteur, home chef, podcaster with John Dudek from Sage Settlements Consulting. How are you, John?
Doing great. Doing great, John. Happy to be here. I'm glad to be
Very,
talking with you.
very good. I'm recording in Napa, California. Where are you today, John?
I am in Newport Beach, lovely Newport Beach. I'm looking out a window to the Pacific Ocean. It's a nice sight right now.
Very good. I recommend Antonello's restaurant. They got a good Neapolitan kitchen in there. It's right
Oh,
near South Coast Plaza. So
okay. All right, great. Yeah, I'm right across from Fashion Island, so I think that's somewhat close
I
there.
think you could walk.
Really?
I think it's
Okay.
right there. I think it's
I'm
Antonello's.
I'm
Just
gonna
tell
do
them
it.
Steve Ebolt sent you. He's my contact there. He was the maitre d' there for like 20 years now. He's at Lavendi in Napa, but it's a good place. So let's get to the task at hand. Today we're going to talk about what is a structured installment sale. If you can, tell the audience how we met.
Well, we met through our contact at First American Title.
Sal
So,
Covarrubias.
Sal Covarrubias, great guy. I've gotten to know him. I know you've known him for quite a long time. And he has been collaborating with a carrier partners of ours. We kind of come from, when I say we, my partner Tanis and I, who's going to be joining us on future podcasts, but we come from the financial planning insurance world a little bit. And one of our carrier partners and Sal started collaborating and kind of brought us in. And we were lucky enough to meet you and your wife Ellen on your home turf up there in Napa, which was quite an experience. Really enjoyed that. But since then, I've really enjoyed our conversations, and I'm looking forward to collaborating further.
Okay, good. So getting to the task at hand, what is a structured installment sale? Let me give you a realtor's lament. I got my license on February 11, 1974, and I think for the most part, we've had a shortage of inventory and homes for sale for most of the time that I've been in business. It hasn't gotten any easier over the last couple of years with people refining and having 2.75% mortgages. They don't want to leave those. And if they have highly appreciated real estate, I just sold the property where the owner bought the property in January of 1966. The $500,000 exclusion for owner occupants isn't going to be enough if you bought it for 70,000 and you're selling it for 4 million. I know we should have such problems. And so people have not been putting their properties on the market until they die. Their descendants and beneficiaries get stepped up basis so they could sell the property and not trigger a capital gains tax. So I'm very intrigued by what you're doing with structured installment sales. Can you tell us exactly what that is?
So yeah, structured installment sales are at their kind of basest, easiest way to understand. It's a tax deferral strategy, tax deferral and tax lowering strategy for someone that's looking to sell property, whether it's primary residence, whether it's an investment property. You can do it with the sale of a business and other highly appreciated assets. Obviously, we're focusing on the real estate here, but it's a way for again, a way for people to get out of that tax trap where they have this large capital gains looming over them, and they don't want to exchange their property. Maybe they can't do it because it's primary residence. Maybe they don't want to do it because they're sick of being a landlord. But they're looking to actually liquidate their asset, turn it into cash, turn it into an income stream. And this is a way, a very underutilized strategy that allows them to do that, defer their capital gains taxes to future years, and hopefully lower them with some strategies we're going to be sharing over the next few weeks and months.
Very good. Now, I understand that the structured installment sales are steeped and authorized by Internal Revenue Code 453 and Publication 537. Can you tell us what those codes and publications inform real estate investors and homeowners about?
Absolutely, yeah. If anyone's looking for a way to fall asleep before they go to bed, they can go to IRS Code 453, which talks about the installment method of accounting. And it sounds a little technical, but really all it means is that if you're selling an asset and you take at least one payment of that sale in the tax year after the sale is made. So if you make a sale in 2024, you take at least one portion of that payment in 2025 or beyond, that counts as the installment method of accounting. And if you utilize the installment method of accounting, that means that you only pay taxes on the money that you receive in that taxable year. So, very basic example, if you have $1 million subject to capital gains and you split your sale into 2 years, you would have $500,000 a year subject to long-term capital gains. Now, you could imagine if you split that up over 5 years, 7 years, 10 years, 20 years, you're really lowering the prorated amount that you have to pay on those capital gains. So that's IRS 453. Publication 537 is kind of a tangent to that, and it really will, for people that are interested and want to do this reading, it'll give you kind of a step by step on how the process works with a few case studies and things like that. So I think that's the more digestible uh, piece of literature if you're looking to actually read up on this.
My personal experience is contrary to expectations. When I went into the Internal Revenue Service website, it's actually very user friendly. It's not obtuse or opaque at all.
Yeah, no, I think they really do a good job. Yeah, you might imagine that it's going to be incredibly technical and a lot of terms people don't understand. But if you're a real estate owner, real estate investor, you're used to these sort of things. I think most people will be able to follow it. But if you don't want to go through that, we're always happy to help navigate those waters as well.
Okay, well, just referencing the traditional sale, if you just sell, you're going to be subject to federal income tax, state income tax, and also tell us a little bit about the SSI or Social Security tax.
Yeah, well, I call it the net investment tax. Some people call it the Medicare tax. Came about, I believe, with the Obama administration, and essentially what it is if you're selling any sort of investment, there's a tax that if you're single, it's the threshold's 200,000. If you're married filing jointly, it's 250,000, and any amount over anything you sell that's over that amount is subject to a 3.8% tax in that taxable year. So you've got your federal long-term gains taxes, which can be as much as 20%. State of California, it can be as much as 13.3%. You add in that investment tax, 3.8%. Now you're looking at the maximum 37.1% of your sale can go towards capital gains, goes right to the government.
Ergo,
Obviously,
people choose not to sell their properties rather than do that. So let's start with a traditional installment sale. How does that work?
yeah, so a traditional installment sale, again, going off the IRS code 453, is it's just a two-party system. You've got a buyer and a seller. So, John, I want to buy your home. The sales price is $1 million, and you don't want to pay some of the capital gains tax. So I say to you, instead of paying you $1 million in 2024, why don't I pay you $100,000 a year for the next 10 years plus some form of interest that we agree to, because you're going to take the money over time. You're going to charge me a little bit of interest in order to do that. So in that way, it's you're able to defer those capital gains, hopefully lower what you're going to pay, and it's a nice system for both of us. The kind of the drawback from the seller, from your standpoint in this example, is that now you've got to rely on me, John Dudek, to make these payments over the next 10 years. And what if I don't make those payments? Now you're become a creditor. You're looking after me. What sort of legal action do you have to take? So there's a lot of risk involved with the seller if you're doing just a traditional installment sale.
Well, I think a bigger risk in the San Francisco Bay Area is not getting paid. It's more getting paid early and triggering a massive tax event.
So you're saying if the buyer just decided I'm going to pay up the rest of my bill, I'm not going to honor the 10-year agreement. I'm just going to make the balloon payment now. Yeah, yeah, and then it kind of defeats the whole purpose of the installment sale because you're getting that big lump sum in 1 year.
Right.
Absolutely.
So tell us how the structured installment sale differs.
So the structured installment sale brings in a financial product that's called the structured annuity. So essentially, it's a tax advantaged annuity, a tax advantaged investment vehicle. Where now you've got a third party in this installment sale. So the buyer and the seller, just like in a traditional sale, they agree to a sales price and they agree to a payment schedule. I'm going to pay you that $100,000 a year for 10 years plus some interest. But then the third party, the life insurance carrier comes in. Our major partners, MetLife, um, very large, strong financial institution. MetLife comes in, so the buyer basically says, "Okay, I'm going to make this payment upfront in a lump sum in year one, and instead of making that payment to the seller, I'm going to assign my obligation to make these payments to MetLife." So now they make a payment to MetLife and say, okay, MetLife, now it's your obligation to pay the seller. I'm paying you up front. You have to pay this seller out over the next 10, 15, 20 years, whatever it is. And then from the seller's standpoint, they're going to receive money from MetLife and they realize that now they don't really have to worry about not receiving payments because MetLife has, tens of billions and dollars of assets and has been in business for 150 years and has never defaulted on a payment. So they have the security of knowing their money is coming from a very secure financial institution, and they still get those great tax deferral and tax lowering treatment that they want to do because of the installment sale.
And the cherry on top is a listing agent, a seller, a CPA, a tax attorney. You, MetLife, can proactively financially model and storyboard what the installment sale is going to look like to make sure it comes in within the state, federal, and Medicare thresholds to minimize the tax brackets and minimize the taxes.
Yeah, that's correct. Yeah. Very, very flexible product, very flexible company. So where in a traditional sale, the buyer may only be able to make payments over a certain period of time, or they're financially uh, strapped where MetLife is not. And you can figure out what's my other income, what is this sale going to generate, how much is subject to capital gains, and then, like you said, kind of work backwards, reverse engineer how long these payments are going to come to me over time so that I'm under the specific thresholds that I want to be under and really minimize that tax obligation.
Well, it looks like a very good financial tool for freeing up people that may feel like prisoners in their home, tax prisoners in their home, or in their business, or in their investment real estate, and convert feeling like a prisoner into a predictable cash flow stream that's going to facilitate the lifestyle that they're looking for the next phase of their lives.
Yeah, yeah, like I said at the top, I mean, this is a strategy that not many people know about. It's underutilized. I think most people think of, the 1031 exchange, the Delaware Statutory Trust, DST, when they're thinking of tax deferral strategies. And this is one that just is not kind of in the real estate universe as a known strategy. So it's nice. It gives people another option if they're looking to sell, if they're looking to move out of the state of California, if they're looking to downsize, whatever they're looking to do. It just gives people more flexibility and gives them the option to pay less taxes, which we're all fans of. I think.
Oh, absolutely, absolutely. And also, if you sell for cash, you're basically reinvesting 63 cent dollars if you ascribe to the theory that you could and probably will be paying 37% on federal, state, and Medicare taxes. Whereas if it's an installment sale, you're dealing with a return on your equity that is 100 cent dollars instead of 63 cent dollars. Do I have that right?
Yeah, absolutely. I mean, that's kind of the other beauty of this we haven't touched on, but I'm glad you brought it up. It's you're putting your full sales price into an investment, earning interest on that full sales price, where it's pre-tax dollars instead of post-tax dollars. So that's absolutely just kind of a bonus because a lot of people would do this if there was no interest earned. Just the ability to spread out their tax liability can save them six figures over a not too long amount of time on their tax liability. But on top of that, you're earning interest on your sales price and you're paying, piecemeal taxes as you go. Just kind of makes it a double whammy.
Very good. Well, this is the first of many video blogs that we'll be doing on this subject because it's a complex subject, and I just wanted to do an overview here today. And how is the best way for our viewers to contact you, John?
So you can see my cell phone right there in my name tag, but I've also we'll send out my email address, jDudek@sagesettlements.com. My partners, Tanis Kelly, T Kelly at sagesettlements.com. You can call us, email us, text us, whatever works best for your viewers. We're more than happy to meet on their terms.
That's right. And that includes possibly meeting at Inglenook Winery for vertical tastings of various vintages of Cabernet Sauvignon, right?
Yeah, that's you just say the word. I mean, you give me about 12 hours notice and I'll get up to Inglenook
Yeah,
anytime.
yeah. I'm usually good for about 3.5 hours. And after 3.5 hours, we should be able to test at least three vintages and do six different financial modeling scenarios, right?
There you go. Throw in a few chocolate bars, maybe.
They do have some 72% dark chocolate. Very good. Well, I want to thank you, John, Sage Settlements Consulting, for imparting your knowledge on structured installment sales here today. And thank you, viewers, for tuning in. And we will catch you on the next video blog. Bye for now.
Bye bye.